All right, here we go. Let's take you over to the weather station.
Way to go.
Angela's in the building. Angela Calla, talk mortgages in a few minutes.
That's right.
It'll be good. We have great weather. It's pretty slow again for the lower.
Calla with us, who does the mortgage show on CKNW.
Nice to see you, Steve.
A lot of things going on as far as CMHC is concerned. So why don't we just sort of let our viewers understand what exactly happened? What changes are coming?
The changes that are coming is they've actually limited the amount of mortgage-backed securities that they're doing.
Okay.
And so this is just another policy initiative on top of the 4 that they've already done the last 5 years. And the intention of this is to remove the Canadian taxpayers' risk or limit their risk on a moving forward basis.
Okay, so a company like CMHC will allow a certain number of mortgages a year. So they're cutting back on that limit, so that will provide, so banks won't be allowed to do as many mortgages, or how?
Well, the great thing is in Canada we have other options. We have Genworth and we have Canada Guarantee, so they're going to adapt their funding strategy accordingly.
Okay.
And the end result is there might be an increased cost to borrowers coming down the pipe.
Okay, so if someone's going to buy a mortgage today or get a mortgage in the next couple of weeks, what will they see significantly changed?
They're going to see a change in the interest rates likely, anywhere from 20 to 65 basis points, which still puts us below where we were 5 years ago.
Right.
So right now, a result is the most popular mortgage strategy being the 10-year mortgage, which is below 4% today at 3.99. So if you have a mortgage or you're looking at getting a mortgage, this is certainly an option that you'd want to consider to protect yourself on a long-term basis and protect yourself from payment shock.
Now, as far as Finance Minister Jim Flair is concerned, he came out against the bank saying they shouldn't being allowed to charge people like 2.99% for, and that's what he's trying to sort of get away from. But what I understand is, and maybe you can explain this because you're in the industry, is why is he trying to make it more difficult for people to get mortgages? And I understand what happened in the States, but a lot of those mortgages were just bad right from the very beginning of people who knew they couldn't afford certain homes. Canada, we have a lot more regulations that are in place, but still, we want to get young people into the market. So it seems that by trying to prevent one thing, he's really preventing another thing, and that is those first-time buyers.
This is certainly a very aggressive move, keeping in mind that the default ratio in Canada is below 0.5%, Steve.
Right.
So this is really, really aggressive, and they're just, some would say that this is a step towards them trying to remove themselves from being involved in the mortgage market by allowing other competition now to take opportunities with this.
Yeah, and what about people who have mortgages already?
Anybody that has a mortgage, Steve, if they're not in a heavily discounted variable rate, they should certainly be taking this opportunity and using time to their advantage to review their options and consider a longer term. And most importantly, most Canadians fear payment shock. So take today's low rates as a gift and ensure that you have the proper plan in place and work together with your accredited mortgage professional to protect yourself from future payment shock.
Now, do you think that that we're going to see mortgage rates rising the next 6 months, or is it a year? Is it too hard? Because the Bank of Canada has been pretty strong about not raising until they feel the economy is at a point where they can.
They've been very clear that they don't intend on raising the prime rate, but prime rate and fixed interest rates are based on 2 different things.
Okay.
And that's a great thing to ask your mortgage provider when you're selecting who should manage your mortgage over the long term. Now, with that in mind, now with the cost of funds potentially going up for the lending institutions, we are going to see a bump in fixed interest rates. So if a fixed interest rate is what you're looking for, now's a great time to go long term and take the advantage of moving now instead of over the next 4 months while the increases start.
All right, so there you have it. You have to talk to someone who knows about that kind of stuff like you. Thanks, Angela.
You're welcome. Always here for you, Steve.
All right, and you'll be on Friday afternoon on CKNW, is that right?
Saturday at 7.
Saturday?
Yeah, you can join us Saturday at 7.
All right, good stuff. Let's go over to Caitlin.
Thank you very much. Very busy right now at the border crossings